Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our FSC show, but we also want to talk a bit about what is happening in Europe and what is happening in Asia when we're looking at natural gas flows, because it really ties back to what are we seeing in terms of usage of not only diesel, but also natural gas. And that clearly obviously directly impacts what's happening in the US. And we really want to go through what we think that means in terms of US activity and what we've heard so far from earnings reports. And then we're going to round that out with just some more economic data that's come out. And shocking, I know, it wasn't all that good. So we want to go through, what does that mean and how is that going to impact, the global economic picture. So with that being said, back to our frac spread count. So the activity completion crews was up by 5. So we went from 290 to 295 spreads. And just to be clear, we thought we were going to end the month at about 300. Instead, we got into about 295. And it's funny because now we have earnings, and a lot of the commentary seems vaguely familiar to what I started saying 6 months ago. And at least they could be so kind as to change the wording so it doesn't sound like it was taken from a show I filmed 5 months ago. But when you look at what is happening right now, we're getting the movements that we were expecting in terms of the Western Gulf, the Anadarko, and the Permian. And the Permian is small, but again, you're getting that. But it's really the other basins that we're starting to get a little bit more activity, especially, again, the smaller ones. And one of the things that we said and we wrote articles on, for those that get the insights, was that we expected to see some of the smaller basins start to get some of that capital, especially as equipment got tight in some of the popular areas. And we're starting to see that as it competes, given where the price deck is and where pricing is heading. So we continue to see a little bit of an increase. Again, nothing crazy, closer to about 300. We initially thought we could get to about 315. That doesn't seem very likely at this point. I think it's much closer to about 300 to 305, with about 325 that are being marketed. Now, I know that there is some different numbers moving around, but the one thing that we do very well is finding the smaller guys, the ones that maybe have 1 or 2 pumps, might be doing spot work. And that's really kind of where we shine in our difference versus where some of the others are. Not to say they're wrong, it's just we're looking at a broader scope, and to say that we're just picking up some things that may not be on their radar, but it's still important if you're looking at the whole picture and not just one specific basin, which is why we think we do have an edge on that front. Now, when we look at rigs, I know more drilling is going to be happy because we were up in total. When you're looking at the U.S., the land was up 8. In terms of total U.S., it was up 9 because we did pick up 1 additional offshore. But when you look at oil, we had oil up 6, gas up 2, miscellaneous up 1. Miscellaneous could be anything. So again, that could be geothermal, that could be a lot of different pieces. But oil up 6, gas up 2. The more important number, and for those that have been following us, you understand how we're looking at this, is the horizontal piece. So you can see the horizontal was up 10. Texas brought on additional 6. So again, back to what we're seeing with the frac spread count, we're seeing the Permian, we're seeing the Western Gulf, we're seeing activity really starting to ramp up. And that's something that we see in terms of, and again, ramping is relative speaking because it's ramping, but in a very minute sense. But when you look at the rig count, that's where you're getting the DUCs, which is why we've been talking about that DUC count flatlining and actually starting to increase as we get into the end of the year, because into the end of the summer, because when you look at activity, you have that move in July. Things start to slow down a touch in August as you get in kind of those dog days. And then as we get to the other side of Labor Day, you get one final push that really carries you to the end of October. Then as you get into November, obviously you have weather dependent. And then you'll also have typically that 6-week break, which is between Thanksgiving and Christmas. So one of the things that's interesting, and we talked about this last year, and it continues to be the case this year, is the private producers continue to be the big push. And now the growth rate is when you look at it as on a percentage. So unfortunately, or fortunately, percentages can be skewed. So even though when you look at some of the different pieces, it looks like the percentage is big. And now on a production side, it is sizable, but it's just put it in context. When you're looking at the percentages, it could be high, but in terms of actual barrels, obviously Exxon, EOG, Chevron are going to be a meaningful piece to that. And just given where the market demand is, and we continue to see a lot of robust exports coming from the U.S., now the spread is actually now at $11 between Brent and WTI, so that's going to keep product moving off the shelf and moving into the international market. But it's important to look at, and especially after you hear what the refiners are saying, and it echoes back to what we've been talking about on the EIA show, and we summarized again in segment 3 of this week. Diesel and middle distillate is the focal point. So how do you minimize gasoline and increase distillate yield? And the U.S. shale really doesn't have a high distillate cut. And that's when you get to those different crude grades and the importance. But there's always a clearing price. And at this type of spread, that's where you're seeing that clearing price. But, naphtha's at a discount. Petchems are struggling when you look at margin. So again, that's gonna hurt some of these different pieces, but there's still a clearing price, and it's still at $98. So it's not, or I should say over $98. So it isn't like we aren't getting a lot of benefit, but that spread is going to sit there just because what is yielding the highest distillate cut, because that they're going to try to minimize the gasoline piece. But even as the oil structures continue to shift, it's really important to understand where is LNG and where is natural gas. So in one slide, you could say, well, China is cutting back on LNG imports. So at the same time, you could say, well, they're cutting back on LNG imports. Therefore, China is there's going to be more LNG in the market, and the U.S. Freeport coming back isn't going to make a big deal. But when you say, but China's importing more pipe gas, because if Russia's not sending all of this into Europe, well, they need to send it somewhere. So now you're getting more pipe gas and pipeline imports into China. So those two are going to offset each other. But at the same time, that should free up a little bit more LNG for Europe. Again, not saying it's going to bring down prices at all. It's just that there's going to be a bit more available to go from one area to another. And this is what we've always talked about, and why I love macroeconomics and energy so much, is because when you pull in a string, you impact millions of others. Excuse me. So as China imports more natural gas by pipeline, that frees up more LNG to move to other locations, and you start to see these shifts. Now, it doesn't mean that you're going to get more miles per ton, because you are, but it also opens up the opportunity for the U.S. to continue to export into the market and still capture a very healthy return on an LNG front, just because we don't see this shift where obviously we're very concerned on Chinese the economic backdrops. I made the joke on Twitter just before. I know economic humor, so the joke is, I guess, relative or in the eye of the beholder. That Goldman Sachs finally took down profit growth or growth in China to zero. It's like, well, obviously. So, but there's still a certain base effect where there's an inelasticity with some of this LNG capacity and natural gas consumption. So you will get some shrinkage in the amount of gas they're going to consume, but also the adjustment is going to put more LNG in the market and allow them to hopefully flow into Europe, because we continue to see the curb from Russia. So right now they're only sending, I think it's about 20% in total of the gas that is normally flowing into the European continent, and that's going to be obviously a big struggle, because how much gas is in storage, how much is available, how much is needed. These are all very important pieces. And at the same time, where does it flow to? If Germany has an over allotment, Does that mean they can send to France? If Poland has above 100%, who can they send it to? And that's where you're going to start to see these pieces. Also, where does the LNG come in? Because obviously Yamal, because not only does Russia send shipped or piped natural gas, they also ship LNG. So that now that you're not also getting the LNG component, where is that shifting into and how is that being displaced? And this just gives you an idea of the large divide between the different gas levels, because Hungary is at 49.2%, but Portugal and Poland are at about 100%. So where do they need to be? Can Portugal send some to France? Is there pipeline capacity? And then we're going to look at how Norway could potentially adjust that. So Germany, Netherlands, Austrian, and Hungary struggle the most to fill up gas storage, and that's going to become a much bigger piece as we get, and if things don't change, as we get into September, October, and we're staring at what the natural gas burn is going to look like heading into winter. Now, industrial uses, industry and household account for more than 2/3 of gas use in Germany. So this is why we've talked so much about rationing and what does that look like. Fertilizers, again, starting to see some of that price premium coming back as we start to see the shortages coming through, because just for safety reasons, you want to make sure that you have as much available for households. Nobody wants anybody to freeze to death. So it's just going to be a question of how much rationing is needed, how much can be pulled in from the LNG market, because there will be a little bit of excess based on Chinese data, based on what's going to come out of the US, and this is going to be very important. So Russian natural gas supply to Europe via the Nord Stream pipeline remain at 20% of its capacity, with transit flows through the Ukraine also expected to stay stable on Friday. So again, still seeing the same type of backdrop, which was shown in that chart. Now, the interesting thing is going to be Norway, because Norway does have capacity to send some additional energy import dependence ratios in Europe. So getting an idea of where that capacity is. Obviously, Norway is negative. They're a net exporter. So you can see who is the most exposed in terms of where do they need to get this pulled from Russia into the other regions. And I think the pipeline link is really important when you look at how Norway is connected into the continental Europe. So there are ways to pivot some of this to send some extra into Germany, maybe if back to who has spare capacity. So if we think to where Portugal is, Portugal's at 100%. Okay, well, how much goes into France and then maybe goes on to Portugal? Can some of that be redirected to go into Belgium or go into Germany? And again, this is going to be an important way where they try to adjust the different flows that are going from these areas. And then obviously it's important of what is going to come from Libya, because there is a lot of uncertainty right now in the Libyan theater. There's been some infighting in terms of how the new alliances are being redirected. That's not just oil. There's natural gas involved, and what is coming from any in terms of into Italy. So if they lose additional Libyan flow, well, you're going to create more shortfalls, which is why the gas component is so important and why we have to start looking at how this is being redirected. So when you look at Saudi crude exports, courtesy of Kepler, here you can see that Saudi crude exports have gone up. Again, we've talked about this before. There's the difference between production and exports. Exports can go up even if production is flat, and that's because they're consuming a bit less internally, putting more on the international market. And then Chinese imports continue to trend lower, and Chinese crude imports on track to decline for a second consecutive year. And as we've been saying, we don't expect China to be the same consumer it once was. We are not saying that Chinese demand is going down. It's just in terms of growth, we're starting to get to this point of saturation, and then you're going to start to get some of that replacement with natural gas, with propane, which will displace some diesel, some fuel oil. So again, you're going to find this equilibrium, and then that's going to convert to some of that oil being sent into other regions. And again, this is something to watch. There's also a certain piece to it where they have a lot of oil in storage, and they're going to, and just based on where prices are, well, why are they going to pay $109, for dated Brent or something priced off of dated Brent. They're going to try to pick up as much Russian crude as possible, use what's in storage, and try to, again, use the best pricing. And the reason why this is all so important, especially as we head into winter, is I think this is a fun chart of hydrocarbons still dominating the global energy mix. So when you look at wind and solar and the amount that they have been consumed, and if you think about the subsidies that have gone into it, and you look at just the adoption into what the world primary consumption is, look at coal, look at gas, look at oil. And obviously oil, is a culmination of fuel oil, diesel, but it's important to look at the trend. So the trend is still up. So even if natural gas doesn't gain any more market share per se, the pie is still getting bigger. So you're still getting more and more consumption. And I personally believe that that natural gas is going to eat into some of that diesel, some of that coal capacity, just because that is the easiest way to really make a dent. But what is the availability of LNG? What is the price of LNG? These are key things. You look at Pakistan right now, which is struggling just to stay alive, on an economic basis, obviously. So they can't afford LNG, so they can't afford diesel. So what are they doing? They're buying high sulfur fuel oil. If you want to get rid of sulfur, if you want to really hit that carbon footprint, you would be pushing for the adoption of natural gas, pushing for the creation of LNG, and making it cheaper and really more readily available, where even if it's at a slightly higher price, the fact that you can get it at that price consistently where everybody can make money, I think is really where we need to go, even though we've thrown billions, if not trillions of dollars of subsidies at wind and solar, and we're just not making that impact that we really need when you're looking at that global energy mix. So when you take this and look at the global footprint and our economic backdrop that we're heading into, you can just look at the credit impulses, which is weaker than in the great financial crisis. And I think it's really important because when you look at the flow of money, when you look at just the shifts that are happening, again, you just don't have corporations really doing all that much. Banks are concerned. Bad debt expenses are going up. There are a lot of issues at risk. And one of the things that, again, we talked about the GDP number the other day. So I just want to introduce this once more, but because it relates to what we're going to talk about. When you look at GDP, exports and spending on services rose in the second quarter, but the change in private inventories was the drag on growth. So that's why it's important to look at what are inventories doing. And as we were saying in Q4, when you had that massive increase in inventories, which was that positive attribution to GDP, you're going to get some of the negative side. So you have to weight the two when you're looking at Q4, Q1, Q2. It's important to understand those pieces and where is spending going to go over the next few months. And here you look at pending home sales. Pending home sales fell for the seventh consecutive month. And I think when you look at the trend, it's just getting worse and worse as we continue through this period. But now when you look at today's data, employment cost went up more than expected. It was expected to be up 1.2%, went up 1.3%. So again, the cost to companies is still high. And that's when you start looking at those pieces in terms of what is driving that inflation. Personal income came in at 0.6%, again, slightly better. Personal spending came in at 1.1%, slightly better. Real personal spending, still slightly positive. Again, this is why we look at some of these different pieces and how you kind of get the question of, well, is Q2 really the start of a recession? Are we there yet? PC deflator higher than expected, which is a net negative when you're looking at inflation, because PC deflator is an important metric to figure out where is inflation going. University of Michigan sentiment, again, things remaining a bit worse. Current conditions slightly better just because gasoline prices going down a bit. People feel a bit better, but expectations still struggling. Now, when we break this down a bit, real final sales to private domestic purchasers coming in a slightly negative. Real GDP versus potential. Again, you're starting to get that slowdown, and we think that does accelerate as we go through Q3, as we've been talking about. And then real personal consumption expenditures, when you look at the disposable income was up 0.7, inflation adjusted though was negative 0.3. So even though income was better than expected, it was still down on an inflation adjusted basis, which is the problem that we continue to highlight with savings at 5.1%, which is the lowest since 2009. So how did people survive Q2? Well, they survived Q2 by credit cards and savings. That is not a footing for a exponential growth as we go into Q3 and beyond, which is why we remain so concerned, especially as inflation continues to trend up. PCE inflation was up 6.8%. That is a massive number when you look at where we are sitting at this moment. Employment costs, in terms of where we continue to move up, the all-important private sector wages and salaries gauge advanced 1.6%, tied for the strongest quarterly advance since 1982. Remember, need to avoid the wage spiral. And this is not something that is showing an avoidance of a wage spiral. This is actually going full bore into it. So the fact that the Fed is coming out a bit more dovish should cause a bit of a pause when you're looking at how inflation is going to come under, how could it really slow given how quickly things continue to move. Battle for talent continues to put upward pressure on wages, creating headaches for businesses trying to balance cooler demand and a desire to build workforce resiliency while trying to manage, again, those prices as we continue to see that upward trend in inflation. Just looking at that in perspective, so obviously I think the bottom right chart is great. Consumer revolving credit going to all-time highs, while savings as a percent of disposable income going to 2009 lows. Just giving you an idea of that is not a sustainable mix of spending. And that's why, again, we are confident in saying that Q3 we're already in a recession now, and Q3 is really going to signify, if you will, the start of the recession. Mortgage rates led 4 quarters, gives you an idea of, again, the single family home prices, why we continue to see those home prices coming down. And that will just accelerate and really make worse, if you will, how that recessionary drop is going to really look. And then when you look at markets expecting the Fed to cut too soon, I actually agree with the Numera basis, where I don't know why the market thinks there's going to be this excessive cut, given the fact that we're facing a wage spiral. Inflation hasn't slowed down at all in the key areas, especially the core areas. So we're going to get the Fed cutting, but again, we went through this in the econ show. I don't want to belabor the point, but again, a big issue as bond volatility has come down, but still remains, as you can see, very elevated versus the last 15 some odd years. So it's something that's going to have to be accounted for. And I think this is the one that everyone needs to think about the most, is employment cost index, wages and salaries, private industry workers divided by consumer price index. So you're still getting, even though wages are going up, you're still getting a negative impact. So technically, if the wage spiral is still in play, because you're still not covering your living cost, your living expenses, you need a bigger, really living cost adjustment, which is going to push wages back up, which is going to create a higher cost, which is going to push up pricing, and you're still fairly tightly wound within this inflationary move, which is not going to be supported by a dovish Fed. So again, more problems ahead in general. But in the meantime, get natural gas. We still remain very bullish on that front when you look at demand on the natural gas side, especially U.S. demand for LNG. For U.S. LNG. So that's what we have for you today. If you have any questions, you can find us in the comments section. You can find us on Twitter. And again, thanks for watching, and we hope you have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.